Hi, welcome to our second mini lecture for Chapter 2, and this should cover Learning Outcomes 2-2 and 2-3. In our last mini lecture, we left off with the steps in the accounting cycle. We were using the Chapter 2 Essentials document as our learning aid. So please, if you do not have that handy, stop this mini lecture, find that document, and take it out, and then restart the mini lecture. So let's review just a bit. Okay, so a transaction occurs. Remember, a transaction is a business activity that has a direct financial effect on the assets, liabilities, or stockholders' equity of a business. We then analyze the transaction. What accounts are affected? Are they increasing or decreasing? And what type of accounts are they? Then we record the transaction in the journal. We call that journalizing it. And a journal is a record of each day's transactions. In other words, a chronological record of the business's transactions. And then we copy the transaction from the journal into the ledger accounts. We post or copy the information into the accounts. Now I'm going to flip over to page 3 so we can learn how to do those steps today. So now we're looking at the document that says how to record transactions using debits and credits. Now remember that an account is simply a place to record increases and decreases in individual asset, liability, and stockholders' equity items. There's a list of all the balance sheet accounts in the Please Print folder, but let me show you what that looks like here. In this chapter, we're primarily going to be dealing with asset, liability, and stockholders' equity accounts. And each one of these accounts, cash, short-term investments, accounts receivable, accounts payable, notes payable, common stock, retained earnings, is going to have their own place, their own account, their own place to record increases and decreases in that account. In their most simple form, accounts can be represented by a T. Hence, we call them T accounts. The left side of the T account is called the debit side. We abbreviate it DR. And the right side of a T account is called the credit side. We abbreviate that CR. This is always the case. The left side is the debit side, the right side is the credit side. Now you're probably wondering, why do we abbreviate debit with an R, DR period? I mean, credit makes sense because there's a CR in credit, but there's no R in the word debit. And basically, the word debit and credit come from the Latin words debere and credere, because this system of recording transactions was actually written down in the 14th century by an Italian monk by the name of Luca Pacioli. It had been in use for hundreds of years in the Mediterranean region, in Greece and North Africa, in Spain and Italy, but no one had ever written it down, so Luca got the credit for it. Now, in the real world, we wouldn't be using these simple T's to represent our accounts and to record activity. We would be using fancier paper. And let me show you what it looks like. It's called the 4-column format. Now, we won't be using this because it would end up using too much paper, but in the real world, each of our accounts would have a page like this, a place for the account name and the account number, because we number our accounts, and we'll show you why we do that in just a minute. We have a space for the date, and there's our T, with the left side being the debit side and the right side being the credit side. Now, as I mentioned, each one of our accounts would have a page like this in a book called the ledger. All the accounts are kept together in a book called the ledger. Now, those accounts are in a particular order. and we're going to flip back to the first page of the Essentials handout to talk about that order. We're going to look at the section at the bottom of the page called Chart of Accounts. In every company in the United States, there is a chart of accounts, a listing of account names and corresponding account numbers. And we'll show you how we use those account numbers when we do analyzing, recording, and copying in just a few minutes. But lots of things have numbers to represent them. For example, you have a social security number, we have an address. Accounts have numbers so that we can use them to make things a little bit more easy in this accounting cycle process, and we'll show you how we use them in just a few minutes. So a chart of accounts, again, is simply a listing of all the account names and their corresponding numbers. Assets are first. All assets have account numbers beginning with the number 1. Some account numbering systems are 3 digits, some are 5 digits, some are 12 digits, but all assets will have a number starting with a 1. Then next in the ledger book will come liabilities, and their account numbers will begin with a 2. Then stockholders' equity accounts such as common stock and retained earnings, their account numbers will begin with a 3. Then all revenue accounts will be next, and they'll begin with a 4. And then finally expense accounts will be last, and their account numbers will begin with a 5. So in the ledger book of accounts, they'll be organized in this way. First assets, then liabilities, then stockholders' equity, revenue, and finally expenses. Now this chart of accounts will be helpful. It's going to be used like a table of contents that will help us find accounts that we're looking for. Okay, let's go back to page 3 in our document. And let's start this process. Okay, first of all, we said a business activity occurs. And before we do anything, we have to analyze it. So this would be our step 1. First of all, is it really a transaction? Does that business activity have an effect on the assets, liabilities, or stockholders' equity of the company? Because not all business activities are transactions. Also, remember the separate entity principle. The business records should reflect only the business's activities, not the personal activities of the owners. And you may have some homework problems you're assigned in Connect in which there will be business activities that are not actually transactions. So remember to ask yourself if the business activity is a reflection of the owner or the business. If it involves the business and it has a financial or measurable effect on the assets, liabilities, or stockholders' equity, then it is a transaction. Okay, so when we analyze that transaction, we start by picturing the activity. If we close our eyes and picture the activity, it's actually easier to analyze. We picture the activity happening and we name what's exchanged. Remember, every transaction involves a giving and a receiving. Then we decide what accounts are being affected, and are those accounts increasing or decreasing. So this analysis part really happens in our brain. Now we're going to show you that we can do this analysis using a transaction analysis form, but we'll only be using that form in the first couple of chapters. Afterwards, you're going to get so used to analyzing transactions, you won't need the form any longer. The next step is to journalize the transaction, and we're going to apply the rules of debit and credit to record it. We won't be using pluses and minuses to increase or decrease the accounts. We're going to be using the left or the right side of the T account to show an increase or decrease. Now, how would you know how to increase or decrease an account? Well, if you know the accounting equation, then you know the rules of debit and credit. assets are on the left side of the accounting equation, the left side of the equal sign. So we're going to increase all asset accounts by putting the amounts on the left or the debit side. So assets are increased by putting the amounts on the debit or left side. Liabilities and stockholders' equity are on the right side of the equal sign, so we'll increase those types of accounts by putting amounts on the right side of the T accounts, the credit side.
To decrease an account, you simply do the opposite. You credit assets and debit liabilities and stockholders' equity accounts.
And that's it. That's the big scary rule. So now let's look at an example here. On August 1st, Sonic Gateway issues common stock to Scott and Angus as evidence of their investment of $10,000 in cash. So let's analyze this. We're going to picture it. Scott and Angus are giving the company $10,000 in cash, and the company is giving them stock. Now remember, we are recording this from the perspective of the company. The company is receiving cash. The company is giving stock. The two accounts affected are cash and common stock. So what's happening to the cash? Well, the cash is increasing if the company is receiving it. And what type of an account is cash? It's an asset. So if I want to increase assets such as cash, I'm going to debit them. What about common stock? Is that increasing or decreasing? Well, the investment of the owners, the equity of the owners, are also increasing. And common stock is a stockholders' equity type account. To increase stockholders' equity, I credit. So now let's do our journal entry. We start first by putting the date of the transaction in the date column. Now bear in mind that when you do some of your homework problems, they'll be using letters. They won't be using dates, but in the real world, we use dates. The account to be debited goes on the first line. We said to increase cash, we would debit that, so we would put cash on the first line and the amount in the debit column. Then to increase the stockholders' equity account common stock, we would credit. That goes on the next line. If you have several debits, all the debits would be listed with the amounts in the debit column, and then each individual credit would be listed with the amount in the credit column. On the last line, we would put a brief explanation of the transaction, but you won't be required to do so in your homework problems. Now, if you have more than one debit or credit, the total of the debits must equal the total of the credits. If you only have one of each, then they must be the same number. Every single journal entry would be recorded, every transaction would be recorded using at least one debit and at least one credit. There are no journal entries with just debits or just credits. So our next step is then to copy that information. We call that posting from the journal entry into our ledger book of accounts, into our T accounts. And we basically follow the directions of the journal entry. We start with our journal entry and we see that cash should be debited, which means put it on the left side. So we would copy the date and then put 10,000 on the left side. Then it says go to common stock and put 10,000 on the credit or the right side. So we put 10,000 on the credit or the right side along with the date. Now, what's this post ref column? That is an abbreviation for posting reference. Remember just a moment ago we said that every account has an identification number. The assets begin with 1, liabilities begin with 2, and so on. In the real world, we would have each account numbered. So let's make up a number for cash. Let's say the account number is 101, and the account number for common stock is 301 because common stock is a stockholder's equity account. Those account numbers begin with a 3. After copying the information, we would then take the account number and put it into the posting reference column. And for common stock, we would put 301. And what this does is it accomplishes a few things. First of all, it tells you where you left off. It tells you that you finished posting, which is helpful if you get interrupted by a phone call or email or something of the sort. It also allows you a way you can trace back to the journal if you are in the ledger and you're wondering what the other half of the transaction is. Now, in the real world, when you're using this fancier paper, there would also be a place where you could put the journal page number here if you wanted, so that you could trace forward. One last thing before we finish this mini lecture, and that is that the normal balance of any account is the same side that you would use to increase this account. We're going to be seeing this in the next mini lecture where we learn how to calculate account balances and do the trial balance. But what this basically means is, if, for example, you increase assets by debiting, you would expect to see a normal debit balance. You would see increases to cash and decreases to cash, but essentially you should have a normal debit balance. For liabilities and equity accounts, we would increase on the right or the credit side, so we would normally see a credit side normal balance. Okay, so the next step is to watch a problem demonstration called Mini Exercise Demonstration of Recording Transactions.